What if it were possible to reach right into your savings account and just steal your money? Better yet, what if it could be done without hacking in, without knowing your password or anything like that? And what if your money was being stolen so slowly that you barely even noticed that it was missing? Say, 2% per year. Well, that is exactly what is happening due to inflation. You're going to want to watch this video all the way to the end because we're going to talk about what inflation is and how you can protect your money. And that happens right now. Hey, I'm Jay, and here we talk about real estate, personal finance, and other gems that can make you money.
Subscribe.
That's right, folks, we're sharing the wealth. The Federal Reserve has stated recently that they are going to try to ramp up inflation. Some investment consultants have even suggested that the Fed wouldn't mind if the inflation rate went all the way up to 4%. You might be wondering, well, is that good or bad? And what exactly is inflation? Well, in order to understand inflation, we first have to understand that the more we have of something, the less we tend to value that thing. Let me give you an example. Suppose you have a demand to have a phone. And what I'm saying is, you need a phone. And good news, let's suppose you have an iPhone. It's the only phone you have, but it's perfect because you need a phone and you have a phone. Bear with me here. Because this is your only phone, and assuming you don't have an unlimited money supply, you probably don't want this phone to break or be damaged in any way, and you probably would not sell this phone unless you can sell it for enough to buy another phone of equal or greater value. Now suppose for a moment that out of the thin blue sky you wake up in the morning and you have two phones. Well, you only need one phone and you have a second phone. So you could maybe keep that second phone as backup in case your first phone breaks, or you could sell the second phone. But you value that second phone a little bit less than you valued the first phone. Now suppose you wake up and you have 10,000 phones.
So many phones!
You have no idea where they came from and just boom, right there, in your bedroom, big old pallet of 10,000 iPhones. Your first thought is, how did my bedroom get so big that I can warehouse 10,000 phones in here? I'll get back to you on that one. But then you think to yourself, what am I gonna do with all these iPhones? Now all of a sudden you have too many phones. Although there is one thing you can never have too much of, and that's people hitting the like button. So if you appreciate this kind of content, just take a moment, do me a huge favor, and click that like button. Anyway, back to the phones. You want these phones out of your bedroom, they're taking up space, you want to get rid of them fast, you might break a few just to see what's on the inside, dunk them underwater just to see if they really are waterproof. The point I'm making is that each individual phone suddenly has less value to you because you only ever needed one phone. With that in mind, you need to know that money kind of works the same way. If you think about all the money in existence, and I don't just mean every dollar and every coin, I mean all the money in people's bank accounts, all of it. You could think about that as being something called the money supply. And basically, the more money we have in the total money supply, the less we as humans tend to value each individual dollar. As consumers tend to get more and more money, prices tend to rise. And this works because as you have more money, you might go out and buy more things. And when the suppliers of those things, the stores and businesses selling things to you, start to run out of stuff more and more quickly, they will realize that they can raise prices. Because when somebody's selling something and they're selling through it too quickly, it means that there's more demand than they have supply. And businesses want to get as much money for the products they're selling as possible. And if they're selling through things as fast as they get them, it's clear that maybe they could charge a little bit more. And so the price will start to go up. And as prices go up for goods and services, the amount of things that each individual dollar can buy goes down. Thus, the purchasing power of a dollar is reduced. This is inflation. The value of your money goes down. And what that means is, even though you have more money in this scenario, you're actually able to buy the same amount of goods and services because the prices of those goods and services has gone up. I first learned about this concept when I was a little kid. I remember noticing that money was just paper. And I asked my mom once, where does this come from? And she told me, well, the government prints it. So I thought to myself, why not just print enough that everybody could be a millionaire? Makes sense, right? Until I saw an episode of DuckTales. There was an episode where the three little ducks in the show, got a hold of a gun that could duplicate things. So of course the three boys thought, well, why not duplicate money? But what eventually happened is they duplicated so much money that the streets were just flooded with money. I mean, street sweepers were pushing cash out of the way just so cars could drive. And you gotta think, with that much money just laying around everywhere, why would anyone sell something for money? They could just go outside and get as much as they want. Obviously, nothing like that would really happen. It's very extreme. But I think it's kind of a neat example because it illustrates how if you had too much money, it suddenly becomes worthless. That's the first time the concept of inflation clicked for me.
But Jay, what does this have to do with money being stolen out of my bank account?
If you think about it, if you're simply storing money in your bank account, that money in your savings and checking account is losing value to inflation. So even though the actual number of dollars you have isn't going down, the amount of goods and services you can buy is diminishing. And the goal is that you'll be losing purchasing power at about 2% per year. This is why you should not be storing large amounts of cash in a regular checking or savings account. If you want to keep your 6-month reserve fund there, fine, that makes sense, I totally get it. Because you want those funds to be very liquid and accessible. That way if there's an emergency, you have some cash on hand to help you out. But beyond that, it doesn't make a lot of sense to keep a large amount of money in a regular checking or savings account if it's losing 2% of its value per year. Think about any investment you can make. If you can get an extra 2% out of that investment, that's a great deal. Well, keeping your money in a checking and savings account is kind of like the opposite. It's costing you 2% per year.
Why is the Federal Reserve targeting to have increased inflation?
Well, it's been decided that a little bit of inflation is actually a good thing. Bad thing for your savings, but a good thing overall. To understand this, we first have to think about deflation, which is the opposite of inflation, and try and understand why that would be bad. So in a situation where there's deflation, prices are going down, and the purchasing power of a dollar is going up.
Well, that sounds good, right? Now you can buy more things with your money.
But it's actually bad, because in order for an economy to work smoothly, money has to be moving, it has to be circulating, it has to be exchanging hands for goods and services. And in a deflationary situation, the money tends to stall out, because people tend to just hold onto their money if it's going up in value. Why would you spend your money when you could just as easily hang on to it and have a better deal the next day, and the next day, and the next day? What I'm saying is, in a deflationary situation, there's incentive to just hang on to your money. Well, that's bad because if no goods or services are being purchased, then businesses can't afford to hire employees. And then employees get laid off. And if there's less people with jobs, then there's less people with money. And if there's less people with money, then there's less customers, which forces companies to lower prices to try to compete for your business. And then we end up being stuck in a downward spiral of deflation that's hard to get out of. Not good. No way. So the next logical thing you might think is, well, why don't we just keep it even? What if we could target 0% inflation so that a dollar is just worth a dollar day after day? So there's a couple of reasons why this doesn't work. The first one's pretty simple. It's essentially the same reason as why deflation is not good. If we could somehow target a 0 inflation rate, there still really wouldn't be any incentive for you to go out and spend your money now. Goods and services that you might go out and buy if you had some incentive, you could procrastinate, which means that the inflation rate wouldn't stay flat for very long, because if you're not spending your money, then businesses aren't getting money, then they can't pay their employees, and you're right back into that spiral of deflation. So just on that principle alone, it's a lot easier to just shoot for a little bit of inflation. And then there's a second reason that's not so simple, and I really don't want to cover it in depth, but I'll just go over it quickly. We have something called a fiat currency. That's a fancy way to say a government has declared that the currency has value. By decree, this paper will be money. It's not backed by gold or any real tangible asset. It's essentially just paper that we all believe has value. And here's the weird thing about it that a lot of people don't think about. If you pull a dollar out of your wallet and think about where you got it, maybe you got it from your friend. If you could continue to trace it backwards, like, well, where did your friend get it? And where did that person get it from? And you just kept going back far enough, eventually you would find out that somewhere that dollar was borrowed. And the interesting thing about borrowed money is that it has to be paid back with interest. Just try to wrap your mind around that for a second. It means that at any given time, there's not enough money in the total money supply to pay back all the money that's borrowed plus the interest. And to kind of understand this, just make it simple. Imagine there was only $1 in the whole world, and you borrowed it. But because you borrowed it, you owe $1.50 to the bank. How would you ever pay $1.50 if there's only $1 in the whole world? Well, you wouldn't be able to. But now suppose they could print a second dollar so that you could pay back that first dollar. But that second dollar was also borrowed and will need to be paid back. So now you got to print a third and a fourth dollar. So on that principle alone, the only way to keep things going is to constantly inflate the money supply. I don't want to go off the deep end in some kind of philosophical rant here or anything. I think the basic point is there's a number of reasons why inflation is necessary with our current monetary system. With a little bit of inflation, there's incentive to not hang on to your money, but to instead spend it. And when people spend money on goods and services, it keeps businesses thriving and allows employees to get paid so that they can spend their money to keep businesses thriving, and the banks are able to loan out money, and then there's more money in the money supply. I think you get the idea. There are a lot of moving parts in the economy. And right now, with what's going on in the world, it's important for you to know that there's actually a lot of deflationary pressures. So for example, movie theaters are empty, theme parks aren't even open, many restaurants have only a fraction of the business they used to have, and on right down the line. There are so many goods and services that just don't have the demand they used to have. Then you end up in a deflationary situation. And since we already know that the feds don't want deflation, they are trying their very best to put their foot on the gas pedal and kick up some inflation. The most recent measurement shows an inflationary rate of only 0.6%, which if the goal is 2%, we're significantly behind that right now. Sometimes you'll see the money supply referred to as M2. It just means all the money in the money supply. So the Fed is doing everything they can to increase the M2 money supply. Morgan Stanley said it's fair to say we have never seen money supply growth as high as it is today. Take a look at this chart. To put this into perspective, the year-over-year money supply growth has never exceeded 15%, going all the way back to 1981. But look at it now, it's creeping up close to that 25% mark. Does this mean that the feds are just going to lose control and we're going to have tons of hyperinflation? It's possible, but I wouldn't count on it. I can remember during the last recession in 2008, the feds were adding a lot of money to the money supply. They called it quantitative easing. They also had record low interest rates, and everybody kept saying there's going to be hyperinflation, tons of inflation, but it never came. I'm not going to pretend to have a crystal ball. You'll have to make up your own mind about what you think is going to happen. What we do know is that the Federal Reserve has 3 tricks up their sleeve to create monetary policy that drives inflation. And we're doing all 3 of them. The first way is through something called the Federal Reserve discount rate. It's essentially the cost to financial institutions for borrowing money. This is why if the discount rate goes down, banks and lenders are able to offer loans to you with a lower interest rate. And if it's cheaper to borrow money, then you're more likely to get a loan, which puts more money into the money supply, which helps to drive inflation. The second way is through something called reserve requirements. What happens is when you bring your money to the bank, they don't just keep it there. They loan it out to other people, but they're not allowed to loan all of it. There's something called a reserve requirement, which allows the bank to only loan out a certain amount of your money. If the Fed can reduce the reserve requirement, then the banks are allowed to loan out more of your money, which creates more money in the money supply, which creates inflation. There's more money because you still have your money, but they also loaned it out to someone else. It's like doubling your money out of thin air. Now there's some money out of thin air magic that even Andre Jick can't compete with. The third way that the Federal Reserve increases the money supply is through something called open market operations. What happens here is that the Federal Reserve will purchase treasury bills in exchange for money, thereby giving the banks more money in reserve to loan out to you. And if the banks have more money to loan, well then they can give you a better deal on the loan. It's obviously a lot more complex than that, but the intent of this video isn't really to get into deep economic theory, it's to just kind of get a sense of inflation, what it is, and why we have it. So what's going to happen? Will the feds be successful at getting the inflation rate up between 2 and 4%? Or maybe we'll have deflation. As I said earlier, I don't have all the answers. I'm not a financial advisor, I'm just a guy on YouTube discussing this topic for entertainment purposes. What I want is for you to understand that these are all possible outcomes, and hopefully you can decide for yourself what you think is most likely. What I do know is that if you want to protect your money against inflation, there are some things you can do right now. The best way to hedge against inflation is to make sure your money is invested in assets. Things like real estate and stocks tend to rise with inflation. But what if you have some money that you want to keep liquid? What if you had some cash and you wanted to protect that against inflation? The traditional advice used to be make sure you keep your money in a high-yield savings account. But with interest rates being so low these days, even the best of these accounts aren't yielding very much. For example, a Wealthfront account is only yielding a 0.35% interest rate. While that does give you a little bit of a hedge against inflation, it's not very much. And you can't just dump all your money into stocks or real estate because that would lock up your funds. But don't worry, there's still something you can do. In this case, I think you should consider putting your money into a short-term treasury bond ETF. Specifically, I like to use SHV on Robinhood. Now I'm going to show you why this is good. This thing is incredibly stable, almost no volatility at all. You can go back all the way to the beginning of time and see that it maintains a consistent value of around $110. Because SHV is a bond ETF, it will maintain its value even if the stock market were to lose value. That's because bonds tend to work in the opposite direction of stocks. When stocks go down, bonds go up. For example, let's look at the recent health crisis. You can see that this ETF actually went up to $111. So it's a very stable way to maintain your money and keep it safe. Of course, whenever you're investing, there always is a little bit of risk, but I would feel very comfortable keeping my money in this ETF. Because this is a managed ETF, it does have a little bit of an expense, and the expense ratio on this is only 0.15%. But to put that into perspective for you, an expense ratio of 0.15% equals about $1.50 per year for every $1,000 you put into this thing. This is going to have a dividend yield of 1.4%. Are you doing the math in your head a little bit? With very little risk to your money, you can get a 1.4% return. If inflation is 2%, this is getting you pretty close to completely hedging against inflation. I still think you wouldn't want a whole bunch of excess money being stored in this ETF for very long. It's okay to have your 6-month emergency reserve in this account, or to have short-term money that you think you're going to need for a future investment. But any extra cash that you have beyond that, I really think you need to figure out a way to invest that money. Consider getting into the stock market, or my favorite, real estate. I hope you guys liked this video and found it informative. If it added value to your life, please hit the like button, and also consider hitting the subscribe button and the notify bell. That's it for now until next time, and as always, you guys are awesome.